So I'm going to go through chapter one. It's an overview, and there's a lot in here. And you don't have to learn and understand everything in chapter one because we're going to be hitting most of it again. But I did want to go through some of the highlights that we either won't be hitting again or that are super interesting. So the first question is, what is corporate finance, the subject of this course? In most MBA programs, finance is the biggest major, and that's the reason is because finance is the skill that most people lack that they need to get into the C-suite. And so corporate finance is all about two things. As it says here, identifying and selecting strategies or projects that add value and then figuring out how to finance them. So very simply, that's what we do in finance is we measure value and then we talk about financing. So the primary objective of the company is to maximize shareholder wealth, which means to maximize the stock price. Now, there's all kinds of misunderstanding about this out there in the world. So people believe that maximizing the stock price is somehow at odds with the other stakeholders or ethical behavior. And so the thing that you will learn in this class, I hope, is that the stock price reflects the long run. And so you can do things in the short run that maximize earnings or net income that turn out to be bad for the company in the long run. But as long as the market has the information, and that's the key. If the company hides information from the market, there's no way they can know what's going on. But if the market has the information, the stock price reflects the long run. So how do you maximize the stock price considering the long run? You make something or sell something that people want, that is good quality. You treat your people fairly, you treat your suppliers fairly, and you behave ethically. Because if you don't do any of those things, it's going to come back to bite you. And so when it comes back to bite you is when your stock price is going to fall. And so it's the difference between maximizing earnings and maximizing stock price. Earnings are a current period measure. Stock price is a long-term measure. And so is it good for society, employees, and customers? The answer is yes. If you understand what it really is, it is good for all those constituencies. Because if you have disgruntled employees, they'll quit, your costs will rise. If you do something bad for society, you'll probably go to jail. If you don't have happy customers, you've got no sales and you've got no company. So maximizing stock price is not the first order condition, it's the second order condition. The way you maximize the stock price is by making everybody else in the chain happy. And so as it says here, and in the chapter they talk about the most admired companies, of which Apple has been the number one for a number of years. Consumer welfare is highest in capitalist economies. Our standard of living is highest in capital economies. And so the most admire firms, in addition to having good stock returns, high quality from the customer's viewpoint, and the employees like working there. So stock price maximization is a very all-encompassing measure, and that's what you need to understand, that it's not in any way at odds with any of the other stakeholders in the company. So this is kind of a big picture view of what we're going to do in this class. So you've just come out of accounting, and so we're going to take those accounting statements and turn them into free cash flow statements, and so we'll learn how to do that in chapter 2. And so free cash flows is what we care about in finance, because free cash flows are what you can take out of the company and do something else with. And so operating costs, investments in capital, that's money recycled in the company. So from the standpoint of an investor, nothing comes to them. And so a company has value if it throws off free cash flow that it's not using for other purposes. And so these are the free cash flows in different years. Don't be scared. And discounting at the weighted average cost of capital to find the present value. And the weighted average cost of capital is simply how much does it cost us to raise money? And we'll talk about this. But so the present value of this is the value of the company. So basically a little bit on financial markets. So who are the providers of capital and who are the users of capital? In general, households are the net providers because households are net savers and corporations are net users. Okay. The government is a net borrower for sure because the federal government runs deficits, but some foreign governments like China are net savers. And so they have lots of money that they're looking for places to put. And so they buy US government bonds and so basically funnel their money into our country. So financial corporations slightly net borrowers, but mostly they break even. But so the most important thing here is that households are the ones that have money and corporations are the ones that need money. So how do we get money from those who have it to those that need it? So a direct transfer, an example would be if a corporation issues commercial paper to an insurance company. So a commercial paper is like a short-term loan, almost like an IOU. And so the company sells this commercial paper to the insurance company. So the insurance company has some money that they want to invest just for a short term to earn some return. So they buy basically the IOU from the company, funnel cash to the company, and then when the company pays them back, they make a small return on their investment. So investment banking firms are Merrill Lynch, Morgan Stanley, those kinds of companies. And so they can do stock sales for a company. And so in an initial public offering, they sell the stock for the first time. After that, the stock trades on the market and the company doesn't make any more money. They can sell a debt issue for a company. They can place it with one investor or they can sell it to many investors. But so individuals put money in the bank and that money gets turned around and loaned out as loans, or they they invest money in mutual funds, or they invest money directly in stocks. But all of that, the money is going from the households that have the money to the firms that need the money. So what's the price of money? For debt, we call that the interest rate. So the interest rate is the cost of the debt or the price of the money that is loaned. And on equity, we just call it the cost of equity or the required return on the stock. And that's equal to the dividend yield plus the capital gain that you get from owning the stock. So what factors affect the cost of money? At a very, very basic level, these are the 4 factors that affect interest rates. And so production opportunities in an economy. So basically, how healthy the economy is. And so the healthier the economy, the more companies are doing stuff and growing and needing money. So the more production opportunities, the greater the demand for money. And the higher the demand, the higher the price is going to be. Okay, so this is on the demand side. This one is the supply side, time preferences for consumption. And so basically that means what's our makeup in terms of saving versus spending? And so Americans historically have had a very high time preference for consumption, meaning we like to buy stuff now. We don't save for stuff. We borrow to buy cars. We borrow to buy houses. We borrow to go to school. We borrow to do everything. That means we have a high rate of time preference. That's very not normal in the rest of the world. In most of the rest of the world, they save their money to buy stuff. And so American households are net demanders of capital for all these loans to buy stuff, whereas people in other countries are saving the money, and so that puts money into the economy. And so getting back to international, if we didn't have foreign countries investing money in this country, we would be in trouble because of the way that we don't save. And so American households do not save enough to fund all of the production opportunities for our companies. So if the rest of the world weren't bailing us out, the fact that we have low rates of savings would make higher interest rates, right? So low rates of savings would be a low supply of money, and that's going to cause the interest rate to go up as well, just like the production opportunities. Risk, the higher the risk, the higher the return. Okay, that's kind of a basic premise of finance, is that investors will only invest and take on more risk if they earn a higher return. So the higher the risk, the higher return. And also, if expected inflation goes up, you get to stay even with that. So interest rates will rise if inflation is rising. Okay, so there's an inflation premium built into interest rates. So at a very, very basic level, these are the things that determine interest rates. So The Federal Reserve policies, budget deficits, all of these things affect the cost of money. And so the Federal Reserve enters this game by buying and selling securities. And so when the Federal Reserve buys securities, they're putting money into the market. And when they sell securities, they're taking money out of the market. And so that affects the supply of money, right? And so they have an impact on the supply of money in the short run. Likewise, budget deficits mean that the federal government is going to have to borrow more money, take more money out of circulation, take it away from businesses. And so that's going to be a decrease in the supply of money. And then we talked about level of business activity. In a recession, activity goes down, less demand for money. Interest rates will fall. That helps you get out of the recession. In a boom, lots going on, lots of demand for money, interest rates go up, and that can put a cap on a boom. So this is basically the business cycle right here. And then international trade deficits and surpluses. Are they net borrowers or are they net lenders to the United States? So these are some common financial institutions that the households deal with. So households put their money in commercial banks, investment banks, savings and loans. Buying a life insurance policy is a way of funneling money. So you buy a life insurance policy and you don't really think about that as investing or savings, but all those life insurance premiums stack up there at the life insurance company and they turn around and invest it. So life insurance companies are a big way for funneling money into the financial markets. Mutual funds and exchange traded funds are ways for investors to buy into a fund rather than an individual stock. And so you don't want to hold individual stocks because it's too risky if you have all your eggs in one basket. So it's better to invest in a mutual fund, which is a diversified portfolio of stocks. And so that's a kind of a direct way that you invest into markets. Pension funds, really similar. Pension funds, you put money aside in your pension fund and they turn around and invest in stuff. And then hedge funds and private equity funds are for high net worth individuals that want to take on more risk. So the financial markets are divided into the primary and the secondary. It's the same place, it's just a matter of time. So in the primary market, that's when companies sell stock for the first time. And so that's the IPO, the initial public offering. And so in the primary market transaction, the company raises money. After the primary market transaction, the stock starts trading, and that's called the secondary market. Okay, the company doesn't make any money on the secondary market trades. That's between you and me, between investors. But the buying and selling in the secondary market determines the price and thus the value of the company's shares. And the secondary market is absolutely necessary to make the primary market go. If investors couldn't sell in the secondary market, they wouldn't buy in the primary market in the first place. So the New York Stock Exchange is the oldest registered exchange. NASDAQ is more of an online market, and I'm recording this in January, and I think in the end of February we're going to be visiting NASDAQ. So NASDAQ is an online market which behaves differently than New York Stock Exchange. It used to be that companies would go public, issue their IPO and start out on NASDAQ, and then as they grew they would graduate to the New York Stock Exchange. The technology companies changed that, and the technology companies have elected to stay on NASDAQ, and I don't know, they think it's, I don't know, a more progressive market. And so it's not true that the largest companies are on the New York Stock Exchange anymore. The New York Stock Exchange is a physical place. If you've ever seen pictures of a stock exchange, it was probably the New York, where people are on the floor of the exchange yelling and screaming buy and sell orders to each other and pieces of paper are flying. The NASDAQ is really a much more efficient market since it's all automated. So here's their relative sizes. So numbers of listings, the market value in the New York Stock Exchange is still much greater than NASDAQ. So here is the interesting kind of story that I wanted to tell, and this is the rest of the slides. So talking about funneling money from those that have it to those that don't. So in this case, these are people that want to buy a house. And in many countries, the mortgage markets do not exist. We go to Mexico often, and in Mexico there's no such thing as a mortgage. And so if you've ever been to Mexico and driven around and seen the dilapidated state of a lot of the housing, it's because you can't get a mortgage to buy a house. So prior to savings and loans, which are the big mortgage lenders, individuals had to save money to buy a house or find somebody that would lend them money. So there was a problem getting money. So Savings and Loans Association solved that problem. And so basically, like any bank, depositors put money in the savings and loan. So it's a way for savers to save. And then the bank pools the money and turns around and lends it out as a mortgage. So commercial banks specialize in business loans and shorter term loans, and savings and loans have gravitated towards making mortgage loans. And so that has been their specialty. So the problem for a savings and loan is that the source of their money is investor deposits, and those can come and go. And as interest rates rise, the bank has to pay a higher interest rates on the savings deposits. They're taking that money and loaning it out as a 30-year fixed rate mortgage. And so the interest rate on that is fixed and doesn't go up when interest rates go up. And so in the 1980s, many savings and loans went bankrupt because of this, because in the 1980s interest rates went very high, and so they were having to pay high rates to get the money, and they were stuck with these low rate mortgages that they were making. So after that crisis in the 1980s, they started pooling their mortgages and selling the pools to organizations such as Fannie Mae. And so the savings and loans gets the deposit, makes the mortgage, and then turns around and sells all of their mortgages to Fannie Mae. So they just got those mortgages off their balance sheet, and they got an inflow of cash from Fannie Mae, which they can turn around and then make more mortgages. So from the standpoint of the efficiency of the market, it shifted the risk to Fannie Mae, but it made a lot more money available for mortgage lending. So the risk isn't gone, it's still there, it's just been shifted to Fannie Mae. But Fannie Mae doesn't want to keep it either. So Fannie Mae puts the mortgages that it buys, it repackages them and sells the shares and sells shares in these pools to investors. And so now we finally shifted the risk to investors. So investors buy these things because they get a higher rate of return than similar securities that they can invest in. Now, these things were marketed by saying, here's a pool of mortgages I'm going to sell you. Not everybody, some individual homeowner might go bankrupt and default on their loan, but they're not all going to default. So you're getting a high rate, you're getting a rate that we charge on these mortgages and not bearing very much risk. And so that's how these batches of mortgages were sold to investors, and that's called securitization. Securitization is when you take one asset and you basically bundle it together and then sell shares in the bundled thing. And so those were called collateralized debt obligations. So Fannie Mae and others started getting real tricky with these things and slicing and dicing the cash flows. And so you could buy just the interest payments. Well, one thing I left out here. So a lot of mortgages during this time were written as I'm trying to think of the name, the kind of mortgage where you pay interest only for 5 years and then you have a balloon payment at the end of 5 years. And so the idea was that the price of your house is going to go up, so that at the end of 5 years you can either refinance or sell your house and pay the balloon payment. So that also made mortgages more available to people. But so the Fannie Mae's and the other people holding these pools of mortgages started slicing and dicing. And so you could buy the first 5 years of interest. You could buy just the balloon payment at the end. You could buy 1 year of interest. And so pretty soon, these things are pretty hard to determine what is in the CDO. It might just be a few slices of interest of some mortgages. And so it got very, very complicated to see what was in the CDOs that were being sold. Other assets that can be and are being securitized, car loans, student loans. This is the next big crisis that's going to happen, student loans and credit card balances. So it's a way for the bank to shift their risk and to increase their cash flow. Now, here's where it all went wrong. So because you could get these interest-only loans, So your loan payment on an interest-only loan is much lower than it is on a 30-year traditional mortgage, right? So people tend to buy the house payment that they can afford, not the house that they can afford. So these interest-only loans had artificially low interest rates, and so people got into, it says, better houses, more expensive houses that they could afford. And so mortgage brokers, when my son graduated from college, mortgage broker was the big profession that everybody was going into, because mortgage brokers were making a ton of money, because they got paid a commission on the volume sold. So if you think back to when the savings and loans were making the loans in the beginning, a savings and loan had a vested interest in making a good loan because they were carrying the mortgage on their books. The minute they shifted that risk over to Fannie Mae, they really don't care so much if you're going to pay the loan off, because they have shifted it, they've sold it to somebody else. And here the problem is exacerbated. Mortgage brokers were paid a commission to sell mortgages, and so they really didn't care at all if these people could afford these mortgages, because they got the commission from selling. And so that caused a big boom in mortgage making. And so the investment banks created the CDOs, and they got rating agencies to say that they were AAA and they were really good. And so they sold these CDOs with these high AAA bond ratings. And basically, what happened next is everybody got to the fifth year. And so the mortgages reset, and people could not afford the balloon payment on their home, and so people started defaulting. And part of the problem was in areas like Las Vegas, this was a big problem. People were buying homes as investments, so they weren't buying homes to live in anymore. So one person might buy 5 or 6 homes. They were buying them as investments. And as soon as you got to the balloon payment and they couldn't make the balloon payment, they just walked away, because it wasn't their house, they didn't live in it, so they just defaulted on it. And so what happened was, remember when I said in this pool of mortgages, one person might default, but they're not all going to default, they all started defaulting. And so some people, some investors had bought credit default swaps, which is basically insurance on the CDO, but it turns out there was nobody on the other side of this credit default swap. There was no money over there like there is in a normal insurance policy. So the bank, or the mortgages, started defaulting, which made the value of the CDOs plummet. The credit default swaps were not any good because there was no counterparty that had any money to pay off. And so people just started going bankrupt right and left. And so this is what happened in the great mortgage uh, crisis in 2008 and 2009, and that took down a lot more industries than just the mortgage industry. So that's kind of a depressing way to end chapter 1, but there's a lesson to be learned here, in that risk doesn't go away, and securitizing it and selling it to somebody else doesn't make it go away. And so we never want to lose sight of what is the real risk and who's bearing it.